Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome to Retiring Well in the July monthly market update. Folks, there's a lot going on, so I'm going to get right to this. First of all, year to date, end of July, S&P 500 up 1.2%, Dow down 7.4%, NASDAQ up 19.8%. Obviously, technology being the bright spot. This is just the S&P 500 over the last 1 year. You can see that big market drop in that 2 weeks and ending in March. And then since has been, slowly trying to climb itself back up. Interesting though, you take the top 10 tech stocks out of the equation. That would be Microsoft, Apple, Amazon, Google, Facebook, Visa, MasterCard, NVIDIA, Netflix, and Adobe. Take those 10 out of the picture, which are basically that dark blue line as you can see in this chart, and look at the rest of the other 490 in the S&P 500, literally almost down 15%. So very, very low concentration of stocks doing well, but everybody else not so much. You can see there's a little bit of euphoria there out in the tech stocks. You can see this is Google search for tech stocks. You can see that climb, and everybody's out there looking at it. This is very interesting. When you look at the NASDAQ, it's now trading at just beyond three standard deviations from its 200-day moving average. All right, folks. Now, you got to understand 3 standard deviations. You're basically getting out into the 1 percentile. And that's where it's trading right now. So very, very frothy. Why does the technology have such a big impact on the overall market as a whole, especially those 10 stocks? You can see it right here. Technology actually makes up the biggest sector, 27.5% of the S&P 500. The next one to that is basically healthcare at 14.5%. This is just when you look at the breadth of what's happening out there with all the stocks. Again, even though those 10 stocks are doing well, this chart is showing less than 60% of the stocks out there are trading above their 200-day moving average. So again, very low concentration where it's at. This is interesting. Back on January 15th, you can see that the percentage of stocks on the NASDAQ that were moving down below their 50-day average was on the decline, while the NASDAQ was on the upcline. Well, that's since corrected, and then it dropped back down. And now since here recently, as of June 8th, we're seeing the same thing. The NASDAQ's going up while the percentage of the NASDAQ stocks that are trading above their 50-day moving average is actually moving down. This is basically the deviation between technology stocks, the technology sector, and the financial sector. The last time this deviation was as great as it is right now was back in 2000 when we had the tech bubble crash. You've got tech stocks doing well right now, and again, just a handful of those doing well, and then the financial sector not doing well. Again, it's not been this high since the last tech bubble. What's holding up markets right now? With the economy fundamentals so poor, what's holding it up? Well, one is those NASDAQ stocks, but it's also all the stimulus money the government's throwing at this. And you can see you got England, Central Bank, Canada, Japan, all doing basically the same. U.S. by far the biggest, and that's what's holding things up. GDP growth, you see the first and second quarter here. Second quarter now, the last revised number was down almost 33%. Now the estimate for the third quarter is up right now. So we're seeing this thing now maybe start to turn. But I thought this chart interesting. The trajectory at which we might get back to where we were at as far as growth is as far out as maybe the fourth quarter of 2021, maybe the first quarter of 2022, another year and a half out. So you got GDP year over year growth rate down almost 11%. Unemployment up 7.5%. 16 million new cases of unemployment. You've got 2020 earnings estimates down 43%. Debt to GDP ratio up 16%. And then, again, the earnings down. And you got all that fundamental news out there in the bad. And what happens? NASDAQ's up 15%. You got crude oil at $40 a barrel. We're going to continue to watch this, folks, because the energy sector is just getting decimated right now. They can't make money at this level. I heard they had to have something like $50 a barrel or more before they're even in the black. So hopefully demand will increase. Travel might increase, and this will change, but for the moment, not good. U.S. consumer sentiment. I shared this last month. It kind of bottomed out. There was kind of an uptick, and now with the pandemic and a lot of the closings and retreat by a lot of the states and that we're opening, now you can see it's kind of driven down. Never has there been such a great disconnect between consumer sentiment and what the market's doing. This chart clearly shows that consumer sentiment, that dark line below, and then what? You got the S&P 500 on the up. Very, very high deviation between the two. To show you how close this is just people's expectations of what they think the stock market's going to do, and what it ended up doing. And you can see that all those blue dots represent how close they were. You see that red dot? That's where we're at right now. So huge disconnect. Small business optimism is on the uptick. We'll see where that's going to go. This is just the S&P 500 PE ratio. It's basically taking the price of the market divided by its earnings. Historically, that's been right around 17 times earnings. It's been quite a bit higher than that for some time, but you can see of recent took a really big uptick. It's now at 27.5 times earnings. Now, that's looking in a rearview mirror at the last 1 year earnings. If you look forward, this is looking at forward to the next 3 years, what they think it might be. It's trading at about 22 times earnings. Now, if you look at this chart, this kind of shows that usually that blue line is the expectations, that yellow line or orange line is what it actually did. You can see that the expectations are usually a little higher than what it ends up doing. So if you go back to this chart here, 22 times earnings, that might even be a tad bit higher that what it happened. So at best right now, you can definitely say things are pretty frothy. This is just what they call the Shiller PE ratio. It's basically instead of looking back 1 year, they're looking back at the last 10 years. It just kind of gives us a kind of an idea or range when bulls start and when they end. You can see that kind of pink bar there. That's when bulls typically end. Well, you can see where we're at as of July 24th. We are well above that. This is just the S&P 500 median price divided by earnings. Very similar to the PE ratio, but if you look below at the orange level there, you can see that we're for the most part at 25 times earnings. We're in overvaluation territory. Now, are we at very overvalued? No. Could this market go up a little bit more before it took a turn? Certainly could. A lot of times people question earnings for corporations because there's a lot of times manipulation they can do of their books. But there's one that can't be manipulated, and that's basically the price of the market to sales. Okay, you can't fool around with sales. They are what they are. You can see right now that the last time it was this high was back in 2000 when we had the tech bubble. You can see where it's at now. This is just an index that's just tracking basically what big money's doing. It tracks basically 1,500 stocks, and then what is big money doing in buying and selling. You can see right now where it's kind of in overbought territory as they're indicating. But I want you to see just right at the very end there, just where it says around 80%, you see that green line. So basically what's happening is you're seeing big money now selling off stocks right now, obviously because they're figuring it's overbought. Not enough has really been talked about in this area. We talk about big business, corporations, and the like, but this is, if you can see the other indexes, if you look at the S&P 500, way to the far right where it says it's estimate, that's kind of where the estimated, price to earnings is going to be. NASDAQ is usually typically a little bit higher, but the one that stands right out to me is the Russell 2000. Estimates are right now it's trading at 110 times earnings. 1 year ago, only at 40 times earnings. So, this is one we're going to continue to want to watch. But, small business, especially small companies are, as this pandemic drags on, if we don't get that recovery like we thought we were going to be, if it really does take another year and a half, how are these companies going to survive? So I dare say that multiple is very, very high. This is just a volatility index, or what they call the fear gauge. It's just an algorithm for determining what they think the market's going to do in the next 30 days, to the good or bad. So a VIX rate at 20 means they think a market might do 20% to the good or 20% to the bad. That's typically where it's traded historically, or it's been around that. You can see that in March when it shot up to about 80. Volatility was very high. It has been slowly moving down right now at about 25. Now, that could mean, as it's moving closer to that mean or norm, that maybe we're entering a period where we're maybe getting a little bit complacent. So we're going to want to watch that.
At Centennial Wealth Advisory, we specialize in retirement planning, helping people like you plan to retire well. We're known all over Northern Michigan for our live events. If you are within 5 to 10 years from retirement or already retired, we invite you to our first virtual live event, and you can see it on the screen. You'll be able to attend from the comfort of your home right on your computer or smart device. Presentation topics include suitability versus fiduciary standard of care, 2017 Tax Cuts and Jobs Act and the 2019 Secure Act, surviving spouse tax trap, 3 retirement success questions you need to answer, 2 similar portfolios but 2 drastically different results, and a little bit about the market we find ourselves in. To register, call 888-608-5825 or visit sen-wealth.com and click on Attend an Event. Don't miss this opportunity and timely live event to help you plan to retire well. Again, call 888-608-5825 today. We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit senwealth.com and let us help you plan to retire well.
If you're retiring soon, it's likely you have many decisions ahead of you. One of the larger ones is Social Security. How are you going to take it? Are you going to take it early? Are you going to take it at your full retirement age, or maybe even delay it? Social Security needs to be viewed as an asset. If you live a long life, it's likely you can collect a large sum of money over time with those payments directed to you. How, though, folks misjudge Social Security commonly is how it's taxed. How are you going to pay tax on that for the rest of your life? And it's important to factor that in when to take it. And also paired with your other assets you may have, it may make great differences as well. If you don't have a Social Security tax plan built into your retirement, it's extremely important and could cost you thousands over your lifetime if done improperly. We would love to sit down with you here at Centennial Wealth Advisory and talk through what that looks like on a larger scale and see if we can help you have a successful retirement.
Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen, or visit our website at sen-wealth.com, and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call.
I always say there's three stages to a bear market. There was the panic selling. We saw that the last 2 weeks of March. Then there's the buying the dip, taking your profits, and we kind of slowly watch that kind of move itself back. So I dare say that's where I feel like we're still at. But you don't typically get to the end of a bear market till you get to that place where, all the realities have set in. People have tried to take the profits, buy the dip, they're discouraged, and it basically starts to hit a bottom. You get to that place where everybody says, it's never coming back. That's typically when you're seeing the bottom. I dare say I don't think we're hardly there yet. This is, when you're at the hospital, the nurse comes in and says, okay, I want you to give me a number of 0 to 10 or where your pain is. Again, we're not going to be to despair till I feel like we're feeling like a 10. Right now, I would dare say most people would say, depending on how well their accounts are doing, they're probably a 4 or 6. And if all you're doing is sitting in tech stocks, you're probably 0, right? You're feeling really good. So, what we got out there is just a lot of uncertainty on a lot of different fronts. You got China tensions. We're going to talk a little bit about that. The pandemic recovery starting to slow down. You got people's spending habits changing dramatically through this thing. Rise of bankruptcies, unemployment, all-time high. How many of these jobs are going to return? Social unrest, rioting in our cities, and to throw all that in, we're in an election year. Just a lot of uncertainty out there. So you got, these China tensions that have been growing. I think there was a consulate. We closed a consulate, China consulate down in Houston. China retaliated by closing one of our consulates down in their country. To say the least, tensions are on the rise, and folks, I just don't think it's going to get any better. I thought this interesting. If you look at what the World Bank thinks GDP is going to be, who's going to be the strongest, you can see we held that position for quite some time. China in 2008 was behind us and Japan. Look at 2024. It's suspected that they're probably going to be number 1 and we're going to be behind them. So I don't see these tensions going away anytime soon. The situation with this pandemic has got significantly worse in several states: Texas, Florida, California, Arizona. They opened up early, and then all of a sudden, they've had to slow things down because there was an uptick. You got states reopening, got stalled accordingly. Some have even had to reverse course, from it. Michigan being one of those. With all that, though, the health outcomes appear like they're improving. There's not as many fatalities. It looks like they're finding some. We don't have the alt treatment, but they're treating people in a way that we're not seeing the fatalities on the rise. Testing has certainly surpassed the goals that they suspected. That's a good thing. So I thought this chart is interesting. You can see by the gray bars, that's the number of cases. You can see that seems like it's mostly concentrated among the younger people. But the blue bar being the fatalities, they seem to be more on the older folks. So, I think it's going to be the older folks that are probably going to be a little less likely to be just jumping right back out there. because they're the most susceptible to this. Even in my own age group, I found it interesting at 15% fatality just in my own age group. So I'm not feeling very comfortable with that myself. And the older you get from my age, it's even worse. So I dare say this is, and you got to understand that age block is the ones that got most of the money in the spending. So if they're not out there, they're not spending. That's not going to bode well for our economy either. People's spending habits are changing, like I said, accordingly. I mean, you look at this in March of 2020, people had 11% go into savings. Now it's 30%. If anything happened through this pandemic, people found out they could get by on a lot less, but because it's happened to them so quickly, they're like, I'm not going to let this happen again. I've got to put some money away so we can survive this. So, but how's that bad? Well, if people aren't spending, that's not good for the economy, right? I mean, 70% of our GDP is consumer spending. So if they're holding back, that's going to make this recovery a lot slower. I thought this interesting. Apple tracks how many people are using the map, for travel. You can see that was on the rise, and now of recent it's slowed down. Same thing with people going out to eat. That was steadily on the rise, and now it's flattened out, starting to head the other way. So again, not good for our economy. Delinquency rates, you can see just shooting up. That's what's going to really be hurting the financial sector, as I talked about earlier, because as delinquency rates rise, banks have to keep back a lot more in reserves, which is less money they can loan out, which is less money they can make. So not to mention the fact that when they have delinquencies and go bankruptcy, they lose that money too. So not good. Box office store closings, with everybody buying online, fearful to get out there. You can see it's decimating a lot of these retails. JCPenney probably being the biggest. You got Macy's, Gap, Sears, Art Van, Pier 1 Imports, and Kohl's, all, heading for bankruptcies and closings. Bond issuance, you can see just spiking up. Companies are, concerned about liquidity. They don't know how long this is going to be, and so they're stashing cash. They're issuing bonds. They're trying to get by the best they can right now. U.S. corporate debt as a percentage of GDP, you can see right here, a all-time high, exceeding that of the 80s, the tech bubble, and even the housing bubble right now. So very, very high. If the delinquency rate hopefully doesn't get any higher than they think it's going to be, but if this pandemic dragged on, that could be very, very hurtful to the financial sector. You can see Moody's 12-month speculation as to where they think the delinquency is going to be. They think it's probably going to peak around 12% and then start dropping from there. You can see the last two times we have delinquency rates that high, we were in recessions. Very much a struggling labor market. Now you see the market react positively when they hear the unemployment going down. And if you can see there by that lower gray bar, it was kind of just slowly moving down. But even right now, still above 10%, folks, which is just very, very high. But if you throw in there people working part-time who want full-time and want a job but not looking, you throw those people in there, now you're around 22, 23%. So labor market's certainly not very good right now. And you can see in July, hiring was starting to slow. As a matter of fact, it was kind of on the rise, and then all of a sudden it's starting to slow down now. So not good. Stocks struggle when there's uncertainty. This is an economic policy uncertainty index. It tracks all the news out there, and when it hears words economic uncertainty, you can see that's represented with that orange bar below. And then, with the S&P, the blue line is the S&P 500. You can see right now it's at all-time high as far as the news out there. I've talked about this before, and I'll say it again. There's a lot of reasons for the social unrest out there. I know it started off. I know there's racism that's all embedded in all that. But folks, what's even more behind that is just how a lot of people have not done well in this last 11, 12 years that we've been in economic recovery. See right here, purchasing power of the dollar since 2008. Even with all that money they pumped into the economy, the purchasing power is down 20% since that time. So people that are going paycheck to paycheck, that hurts them actually quite the most. Income share, the richest 10%. I thought this very interesting. You can see that right now the top 10% have better than 50% of the wealth of the economy or the country. The last time it was this high was back in during the Great Depression, right? And what did we see shortly thereafter? I showed you this last month. I just want to show you again. It's like, since 1989, the top 1% have done had a 300,000% 300% increase in their wealth. Look at the bottom 50% represented the blue, absolutely no increase in their wealth. I think it's that's causing a lot of social unrest out there. If we don't do something to boost up our that lower 50%, I think we're just going to see more and more dissent as we move along. So to say the least, there's a lot of uncertainty out there. The roadmap going forward is, right now, stay defensive. Things are very, very frothy out there. I want to look for that final stage in this bear market, for a bottoming out there. And then some, better news on the pandemic front. And you give me those two things, the bottom of the bear market and some positive news on the pandemic front, and that's going to be a great time to get back in, dial up our risk exposure a little bit more, and partake in that. So hopefully you found this of value. If you have any questions, certainly give us a call, let us know. Stay healthy.
At Centennial Wealth Advisory, we specialize in retirement planning, helping people like you plan to retire well. We're known all over Northern Michigan for our live events. If you are within 5 to 10 years from retirement or already retired, we invite you to our first virtual live event, and you can see it on the screen. You'll be able to attend from the comfort of your home right on your computer or smart device. Presentation topics include suitability versus fiduciary standard of care, 2017 Tax Cuts and Jobs Act and the 2019 Secure Act, surviving spouse tax trap, 3 retirement success questions you need to answer, 2 similar portfolios but 2 drastically different results, and a little bit about the market we find ourselves in. To register, call 888-608-5825 or visit sen-wealth.com and click on Attend an Event. Don't miss this opportunity and timely live event to help you plan to retire well. Again, call 888-608-5825 today. We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit senwealth.com and let us help you plan to retire well.